we're all set to go, and we'll have a couple trickle in here in just a minute. But really excited today to introduce Ian from Regdee. Regdee is a service that is helping non-accredited investors to become accredited. So a couple topics we'll discuss, as you probably saw in the email. What is an accredited investor? Why become accredited? Why invest in private marketplaces, which if you're a left field investor, you probably have already answered that question. How to become an accredited investor and how Regdee makes the process easier. Ian and his co-founder Brandon are on a mission to make financial education and investing opportunities more accessible. So without further ado, Ian, I will turn it over to you. We've got your screen and you are all set to go.
Sounds great. Thanks, Ryan. I really appreciate the opportunity to speak with left field investors today and tell you a little bit about our story and how we're looking to basically make financial market access ubiquitous. So thanks again for your time, guys. I guess to get started, so Regdee was basically founded as a company to basically make financial access and education ubiquitous and universally accessible. And our sort of first focus area with this is helping non-accredited investors become accredited. I'll start with a quick background on myself, just so everyone has a little bit of a context. But my career basically started about 10 years ago. I started working for 2 years at a venture capital firm focused on structured credit and consumer finance companies. Spent 2 years there, broke off and built a structured credit analytics company with one of the partners of that firm. Worked there for 4 years. Briefly worked in the investment advisor space for another startup. And then have spent basically the last 3 years or so working at Better until recently, this past year, when later in the fall, my co-founder Brendan and I basically came up with this idea for Regdee. So without further ado, I'll kind of jump into it. So let's start. What is an accredited investor? Some of you are probably very familiar with these terms and these criteria, just by virtue of kind of living and working in this space. But traditionally, the criteria for becoming an accredited investor, you have to have demonstrated for the previous 2 years income of $200,000 plus for an individual or $300,000 for the spouse, with a reasonable expectation of that going forward. Otherwise, you need to qualify on the basis of net worth. So that hurdle is actually quite onerous, in our opinion. It's $1 million of net worth, and importantly, that's assets less debt, and you cannot include the value of your primary residence in that calculation. So this is kind of, I think, onerous, obviously, that you could have like a $4 million house with only $1 million debt on it, and you technically could not qualify feasibly. So let's fast forward a little bit. In 2020, the SEC basically amended these criteria to make this opportunity more open. There are two really big amended criteria, a couple other ones that are smaller, but basically now you can qualify on the basis of a professional designation, which means you pass one of 3 series exams and then register as an investment advisor. The 65 is the only one of these exams that can be done without a sponsor. There are 2 other ones as well, but we won't talk too much about those today. And the second one is a knowledgeable employee of a private fund. So if you're a qualified director or officer of a fund in which you are working, you can invest in that fund, but this is only limited to that specific fund. This was done basically to make sure that you have CEOs or directors of a certain fund were employed by this fund but couldn't actually invest in it if they didn't meet the income or wealth criteria. Seemed kind of nonsensical. That being said, I'm going to focus a lot on the professional designation, as this is pretty much open to anyone. So I'll stop here for a second and say, why would I want to become an accredited investor? I think this is probably clear to a lot of you guys, but it gives you access to unique and restricted investments that you otherwise would not have access to as a retail investor. This is not an exhaustive list here, but you can see that there's a lot of stuff here that has been lucrative over the past 15, 20 years. So startups, pre-IPO equity, real estate partnerships, private equity and venture capital, small business roll-ups, private credit, and hedge funds. It's important to note that a lot of this opportunity has actually been democratized into online platforms over the last like 5-10 years. I'm sure some of you are aware of online platforms like AngelList, Moonfair, Cadre, Percent. There's like a ton of them now. Almost all of these have like pretty onerous investor accreditation screening processes in place. In the past, these investments have largely been self-attestation. 506B offerings allow issuers to have up to 35 non-accredited investors in a given deal. But this would require that that issuer and that investor have a pre-existing relationship. What's become more proliferated now is the 506C deals, wherein you can't market these deals unless you're also vetting those individuals to be accredited investors. So why private markets? I think this may be also pretty well known to many of you, but I think the first thing we'll start with are, the last 20 years returns. Over the last 15 to 20 years, the returns in private markets have broadly exceeded the similar returns in public markets. For the sake of this discussion, private market assets include venture capital, private equity, private credit, real estate, and then public markets would include stocks, bonds, other publicly traded like real estate vehicles, such as REITs. So what you're looking at here on the left is returns for private market investments for state pensions over time benchmarked against similar public market returns. This example portfolio here is actually the publicly traded portfolio is 70% weighted to Russell 2000 and 30% weighted to the MSCI ex-US markets index. It's just kind of a example of a balanced portfolio and sort of similar growth assets. The returns and consequent spreads that you see will change depending on the different survey or study that you see, but generally what we see is that there is a spread of around 4 to 7% between the private market returns over the last 15, 20 years versus public market returns. We typically see private market returns yielding 11 to 14% annualized over that time period, with public markets yielding like 7 to 8%. Now, I'm sure most of you guys understand the effects of compounding, but for the sake of illustration, a $100,000 investment in a private market opportunity returning 14% versus that 7% held over like a 20-year period would yield a significant difference in NAV. And that's obviously not accounting for deductions in management fees. It could be like north of $1 million. The second reason why we think private markets are attractive opportunity is the current institutional allocations. So while it's true there's no certainty that private markets will continue to deliver these outsized returns relative to their public market counterparts, it's clear that institutional investors are betting on it. What you see here in this graph is basically what private and public colleges, this actually comes from a recent blog post that we posted on our site, which you can read if you choose, but basically private and public colleges endowments have recently shifted their allocations to private markets from private markets substantially over the last 5 years. So on the left, what you see is a bar showing what their allocations were to each of those markets in 2017. And on the right, what you see is the bar that shows what the allocations were last year. So as you can see in the dark blue, those allocations have both exceeded 50%. So both of these, both institutions or groups of institutions are very clearly betting that continued alpha will come from private markets. And you see this kind of across the investment management industry, where a lot of investment firms that previously bet predominantly in the public markets are basically shifting their allocations to private markets instead. Now, a huge driver of this is information transparency has become so ubiquitous in public markets that a lot more of the edge and returns will come from private markets. We think that unless you have the resources to pay for the latest data and the best talent, it's really hard to have an edge in public markets anymore. But we actually think that retail investors actually have an edge in private markets because they have specialized knowledge and the ability to be patient, which we'll talk about more in the next slide. So why else private markets? Another added benefit is diversification. So particularly allocations towards private real assets and cash flow generative assets, much like the ones that I understand LFI is actively looking at and investing in, that allows an investor to build a diversified portfolio. Public and private markets have different end market characteristics. their liquidity is different, participants are different, mark-to-market frequency is different. Although they're not perfectly uncorrelated, you can see in the graph here from Goldman Sachs Asset Management that these correlations with the public markets are not very strong. I think one of the beautiful parts about the US financial system is obviously, it's easy to get financing for private, private real estate here. But what's kind of tough about that is, you have this concentration in a given real estate investment, means you tie up a lot of your capital, you tie up all of your focus on one piece, versus if you can enter in a private market real estate partnership, it's a lot easier to diversify yourself across these different real asset investments. And the last thing that I want to touch on here is a longer term investment horizon. So this is kind of a personal belief more so than substantiated with any data, but we think retail investors being locked out of private market investments is actually doesn't make a lot of sense, because retail investors are uniquely tuned for these opportunities. A lot of retail investors get caught up in ticker tracking or day trading, watching stocks go up and down. And when they do so, they open themselves up to sort of taking the short-termism perspective, thinking they can beat the market. Most cannot. The edge that almost every retail investor has over a institutional investor is time, right? They have the ability to wait out their investments, while institutional investors need to hit performance benchmarks to satisfy short-term timeframes, quarters, years, where they have to beat these benchmarks. The retail investor is only beholden to themselves. And for that reason, we think that retail investors are actually uniquely tuned for these opportunities. This is similar to sort of the coffee can portfolio thesis, which some of you may be familiar with, wherein it's believed that retail investors benefit best from buying assets at reasonable prices and just sitting on them for long periods of time to maximize the returns. So this is why we think private markets, in a few reasons, are uniquely tuned for the retail investors, and where one of the few places where retail investors can still have an edge. Last thing I'll kind of note is retail investors do have specialized knowledge or geographic expertise that institutional investors hypothetically do not have access to, because there is a lag between when they can purchase the data to understand trends and understand like the nuances of like certain geographical areas. So we do think retail investors have an edge here in that way too. So enough about sort of the private market characteristics. Let's talk about how you would become an accredited investor. Now, this opportunity to become an accredited investor is totally open to anyone. If you don't qualify on the basis of income or assets, anyone can do this. You would just need to register as an RIA and an IAR under that RIA. So RIA refers to the Investment Advisor Organization, stands for Registered Investment Advisor. IAR stands for Investment Advisor Representative. So typically what you do if you wanted to go through this process, it's a two-step process. First, you would need to pass the Series 65, and then you would subsequently need to register, complete the registration process. Now, this registration process is in several parts. You basically would have to file out forms to register your RIA, your Registered Investment Advisor, which goes through a vetting process with either the state regulator or the SEC. And then you need to file yourself as a representative underneath that org. Anyone can do this, and we actually outline these steps on our site because we want everyone to have the transparency of this information, understand this exists for anyone who's willing to go through it. However, it is an onerous process, and for that reason, we've sort of sought to make a simpler solution for all of our prospective customers and advisors. So Regdee, how does Regdee make it easier? So what we do is we've set up our own RIA, our own advisor organization, that all representatives that we bring on board can then be part of. And in this model, you would basically pay, a prospective investor would basically pay us a flat fee to register underneath our RIA. This allows you to become an accredited investor and an investment advisor, and potentially earn a stream of income from being an investment advisor under that RIA. So for this fee, you get access to our policies and procedures, our compliance layer, our compensation structure, and the technology to track all your customer interactions to make sure that you stay compliant. To give you an idea of this timeline, it can take 30 to 60 days depending on sort of the amount of back and forth. But what would typically happen is we operate in the asynchronously, which means we're doing things while you're doing things so we can make sure that we streamline your process. So what you would do is you would purchase study materials for the Series 65 exam and begin studying, and then submit registration information to our online form. After you do so, you study for the Series 65 exam while we complete the registration form on your behalf and handle any back and forth that comes with your registration being deficient, and then work with you to fill out those deficiencies. Meanwhile, you're studying for the test. Once you have a good idea of when the test, when you'll be prepared to take the test, you can schedule the exam. And from that time you schedule the test, the timer starts, which we'll go over in the subsequent slide. Day 30 to day 45 to 60, let's say you pass the exam, we've completed your registration. So your registration is effective with our associated RIA. You are now an accredited investor and an investment advisor with our associated firm. And then we handle all the firm registration policies and procedures that we basically give you to adhere to. And then we handle any ongoing education that's associated with that. So about the Series 65 exam, I'm sure this is something you guys will have a lot of questions about. But basically, it's a 3-hour exam. You take it at a testing center proctored by Prometric. When you go to the testing center, it's basically like going through a lighter version of TSA. You'll walk in, go through a metal detector. They'll just make sure you're not cheating. They'll check your glasses, pockets, etc. The test itself is 130 questions with 10 dummy questions where they don't score. It's all multiple choice. You do it on the computer. You have to answer 94 of 130 questions correctly to pass. So it's a 72%. In terms of preparation, we typically recommend 2 to 4 weeks of study for like cumulative, 20 to 40 hours. I have 30 here, but it's more like 40. You can take the test up to 120 days after paying for the exam. If you'd like, you're free to use whatever study materials you'd like. There's everything out there from, a $50 Kaplan book, which a lot of people have used with success, up to like a $600 immersive course with Notman Marks, which is considered sort of a best-in-class partner. We partner with a particular firm called Achievable, which offers a $200 all-digital offering. We like it because we think it's a good value, but free to use whatever materials you'd like. In terms of materials covered, so this group will probably be well-versed in a lot of about 40% or half of the test, and that's economics and business, investment characteristics, investment recommendations and strategy. But the last half of the test is very domain specific. So it deals a lot with compliance, regulations, and ethics, allocations towards certain assets that can be a little bit tricky. You have to really have an understanding of what they would want you to do as an advisor in terms of recommending certain asset classes to clients. So that part you would need to study probably a little before. The beauty of this all is it's mostly memorization, like understanding rules, regulations, etc., versus mathematical concepts. If you're familiar with, how options are traded, how convertibles work, things like that, there's not much math involved in this test. Some important notes on the time frame. So if you schedule the test, you have 120 days from scheduling to pay for that. Or I'm sorry, from scheduling and paying for the test to take the test. Your timer sort of starts. Before that, you can take all the time in the world you need to study and get an understanding of how much time you'll need to spend to pass the test. If you do fail the test, you have to wait 30 days until retaking it. And you'll have to wait 30 days each time until the third failure, and at which point you need to wait 180 days. So it's really important that if you fail it once or twice, that you really kill it on the third time, because otherwise you'll have to wait. Each time you do fail the test, you would need to pay again to schedule the test. The good news is the test is a 70% baseline rate, or baseline pass rate. That is regardless of the study materials used. if you use achievable or not met marks, that pass rate goes up. Important notes about registration. We'll begin the registration process while you're still studying. Once we collect all that information from you up front, it's really easy to go through and file your registration. That registration becomes effective 30 days after that registration is satisfactorily submitted. And it's very possible, as we sort of improve our efficiency here, that you'll be fully registered by the time you pass the test. I think the last question people will have is kind of fee comparison. So if I wanted to do this with versus without Regdee, you can go through both paths. And I think a lot of people may find that they want to do this without instead of their own RIA, which is totally fine. And we want to give people the information transparency to do so. You're looking at roughly, it's called, just to keep it sort of general, it's called $1,000 in total fees to set up your own RIA, and many of those will be recurring. So call it, $1,000 up front, and then probably $200 to $300 of fees on an ongoing basis each year. We estimate that's 5 to 10 hours to complete the registration process, and about an hour or so to sign up for the test. I will say that the software stack that these guys use is pretty archaic, and it is really frustrating. We still find it frustrating having worked with it for a while. We try to simplify the model. Sorry, one other thing, when you do set up your own RIA, you will need to hammer out those policies and procedures that need to be signed off by the SEC and considered compliant, or the state regulator. Working with us, we try and simplify that substantially. We just charge a flat $500 fee, excluding any of the state registration fees, 365 exam fee, and the exam prep materials. And we just charge $500 a year, basically to rent our infrastructure to actually go out and advise assets, to become an accredited investor, and to handle all the registration. With this, you can just focus on studying and passing the exam, provide us a registration, and then each year pay us to continue to operate under our RIA. And I think the beauty of this is we are looking for advisors who not only want to become accredited investors, but we want to find people who want to go out there and advise external money and generate sort of second stream of income. Sort of an aside here, but one of the things that we're bullish on is sort of in the direction the economy is going. There will be sort of a transition, I think, in the future to a lot of people taking on like second streams of income to supplement their primary stream of income, and we want to be an enabler in this space. So that's about it for the general presentation. I wanted to leave most of the time here to sort of go through Q&A, as I would imagine there would be a substantial number of questions about this, and kind of open it up to the room. So I'll pause there. Ryan, I'm not sure if you're still on.
Yep.
Cool. So I think.
Here's my camera. Thanks, Ian. I appreciate you going through the presentation. I know I've got a couple questions, but so we've got some coming in. So if you guys have them, it's easiest to go through the Q&A. Otherwise, it goes in the chat, but Q&A section is the easiest way to make sure we get your questions answered. So, Ian, I'll just read these off here. So first question that came in, how many individuals have received accreditation through Regdee?
So to date, fully accredited, we've gotten a handful of individuals through, like 5 to 10. Keep in mind that we started at the end of last year. So this process, the 60-day timeline, you're basically looking at the start of the business, if you will. In terms of how many individuals are we getting through currently, I think we have about 25 to 30 as it currently stands, at varying parts of the process.
All right, thank you.
Should I mark these as answer live? Okay, cool.
Yep, I got you. Arthur's asking, how would an advisor charge their clients? Flat fee or percent of AUM, etc.? So more on the advisor side.
That's a great question. So the structure that we have in place is, and this will probably be tailored and tinkered with, is we're basically allowing our advisors to collect a flat fee up until a certain asset threshold. So for the first, I believe it's 50,000 that are advised, you collect a flat fee. But once those assets advised go over 50,000, we set up an AUM fee of 1%. And this will allow you to basically earn income on every dollar that you advise over 50. We really do this that way. There's still like a substantial amount of income for our advisors under a certain threshold, with fees sort of accruing quickly over that 50%. I will note that the one thing that we've tried to make super clear is that flat fee, in order to act as an advisor, the client needs to have, excuse me, over $10,000 of investable assets. The reason why we do this is to make sure that we're not charging fees disproportionate to the amount of assets they're, investing, and therefore charging a fee that could be considered less than the actual net effect that they'll get from the advice, if that makes sense.
Okay. Next question. Preston's asking, what's Regdee's philosophy on investment? If you work as an RIA for Regdee, would you have us advise clients to invest in the stock market or private market asset classes? And how do you set that up for those that do want to pursue an income stream or advisement under Regdee?
It's a great question. I think the way that we're going to do this is it's going to be an iterative process where at first we're going to predominantly suggest that all advisors advise sort of vanilla indices that represent either growth or value opportunities for their potential clients. The reason why we want to do this is we want to avoid, either our representatives or our RIAs sort of getting in trouble for recommending stuff that may be considered too exotic, just transparently. Over time, we'll probably add and layer in more complexity to that strategy to have certain things that we, we'll narrow in on certain asset classes, and even more specifically, like certain assets within that asset class. If that makes sense.
Yep. Arthur's asking, would advisors be self-employed or employees, W-2 employees of Regdee or 1099?
I believe the answer to this is 1099. It will definitely not be W-2. The answer is either self-employed or 1099. Still hammering out the specifics of that, but I believe the answer is 1099.
Okay. If I understand correctly, how does Regdee choose which clients are offered to become advisors for third-party clients?
Let me read this one. If I understand correctly, how does Regdee choose? I'm not totally sure I understand that, but let me take a shot at it. I think the idea here is basically that we give you the infrastructure and the technology infrastructure and sort of the compliance layer and policies and procedures, and then you would go out and actually choose those clients. You would go out and say, hey, I know certain individual who has $50,000 or $100,000 of assets that he doesn't know anything about how to manage it, he or she, and then you would go out and actually and win that business. I think the idea that this is not dissimilar from, I hate to use this analogy, but like an Uber, wherein you go out and you actually source sort of, you are responsible for the sales component, and you are more or less renting our infrastructure and our policies and procedures, so that way you can earn that income. If that makes sense.
Okay.
If that didn't answer the question too, I'm happy to take another shot at it.
Yeah, Terry, if that didn't get exactly to the point of your question, feel free to add back to it. Another question, as an RIA, what's the overhead requirement, FINRA compliance, and having everything monitored?
That's a good question. It really depends on whether you're going through the SEC registered route or the state registered route. Some states are very lenient, and some states are, more strict. And then obviously the SEC has pretty strict compliance framework. What we've done in the past is basically set up individuals with their own RIAs as internet advisors. What that requires is you to have software form on a website that actually provides investment advice by algorithm, which we've done for some of our users. We found this wasn't a very attractive model just because they would be responsible for tracking customer interactions, and demonstrating that they're adhering to their policies and procedures. So in terms of overhead, what you'd have to do is fill out, to start, you'd have to fill out what's called a Form ADV. In this Form ADV, you basically walk through your compensation structure, what advisory fees you charge, whether you take custody of customer assets, whether you have discretion to trade on their behalf, whether you are compensated soft benefits for business, basically, and basically state any conflicts of interest. From there, you would basically have to have a record of all the transactions that you did with any individuals that you advised. The risk being that down the road, you could be audited to make sure that you weren't stepping out of bounds. I think that basically answers the gist of the question. Is there anything specifically that, in addition to that, you had in mind?
So again, if you want to elaborate on the question, all right, we've got another one coming in. Do alternative investments fall under the client or under the investment products that an advisor could offer their clients?
So the answer to this is yes. A couple key things to note here is, one, this probably falls outside of the framework of our policies and procedures to start. Probably won't be the case for very long. The other thing that's important to know is that, and you may know this, but you'll have to actually have a fund that you can recommend those clients to in order to get them into it, right? So typically an alternative investment would have to be, a hedge fund or a private equity fund that you can actually get an allocation into to give to that client. So that's the one thing I just caution there.
Okay. And I know for those that are going to be watching on a recording, can you elaborate? So a lot of the questions that came in are along the lines of if someone wants to become an RIA and they want to advise clients. I know that a lot of probably the interest from our community will be the path to accreditation. So can you kind of talk through a little bit more about, and you did in the slides, but just kind of summarize a little bit about, if I want to become accredited, this simplifies the process, and maybe go back to that slide if you want to reference it. But I know in the recording, that'll probably be the primary question that comes up from our community, aside from the income opportunity.
Yeah, so in terms of the accreditation process, so there, should I pull back up this? Oh, it's still sharing. Okay, cool. So in terms of the accreditation process, it's basically a two-step process where you need to, one, pass the test, which involves studying, getting study materials, etc. And the second step is registration. And this is if you want to do it completely on your own. What you would basically do is register a new RIA, a new organization, and file these forms that are given here, the part 1, part 2, part 3, for that organization, and pay the associated registration fees. A lot of cases, you'll have to hire a lawyer to do this. I know for our advisor organization, we've hired a lawyer to do ours. Some people can choose to do it themselves. It is doable by yourself, I can say that. And then the second part of this registration is registering for yourself, the individual within that RIA. So again, sticking with this concept of registered investment advisor being the organization, and then IAR, the representative, being the individual. You're basically registering yourself as an organization, an LLC, sole proprietorship, and then yourself being the advisor. And then from there, you'd have to basically pay like specific state registration fees if you're filing with the state regulator, or state notice fees if you're filing with the SEC. Typically, you need to have a certain number of assets. I believe it's 100 million to file with the SEC, but there are several exceptions or exemptions where you can qualify. One of which is, being an internet advisor. But otherwise, you would have to qualify under the state regulator, and that process differs from state to state. But generally, these parts right here for that RIA are required. And then you'll always need to file your Form U4 for your individual IAR.
Okay. We had one more question come in, and I guess just to elaborate on that point. So really, there's two use cases, and in some cases a dual use case. One is to
Mhm.
become an accredited investor. The next is if you want to advise clients for compensation, or both.
Mhm.
So there could be two use cases there. Is that right?
Yeah. Sorry, say that one more time.
So one is to create an additional income stream and become an advisor, and the
Mhm.
other use case is for a path to becoming an accredited investor.
Right. So the path is the same
Yep.
regardless. We encourage all of our individuals who come through to do to find AUM to advise, but it's not something that's necessary. This isn't also a pathway to accreditation, and you would still need to follow these exact same steps. Um, and that's why we think our model is a little bit more beneficial because it's just less brain damage. Like, rather than having to set up your own RIA and set up this whole organization with policies and procedures, you just decide that you want to work with us, and you are free to go out and raise external money and advise it if you choose. But you also qualify as an accredited investor operating within our RIA.
Okay. Last question that we had come in: what are the cases when you do not want to be an RIA?
So I'm assuming this is if you don't want to be an RIA, like if you don't want to go through sort of the setup costs and time of setting up your RIA. Unfortunately, if you wanted to go an independent path and not work with us, you would need to set up your RIA. Now, if you don't want to go through that process, that's kind of the value added benefit of what we're offering is, we remove that sort of brain damage and those costs for the RIA setup, and we kind of take those on ourselves and then allow our IARs, our representatives, to roll underneath our organization. Should we know that there are some drawbacks to this? Obviously, there are, our P&P, our compensation structure is ours, and you cannot tailor it to what you would want to do. But the added benefit is obviously you don't have to go through that setup process.
All right. If you meet the asset value requirement, what do you do to get accredited for a newbie?
Is this? Let me make sure that I understand this appropriately. I'm going to answer it in the way that I think I understand it. And then if not, just feel free to respond. If you meet the asset value requirement, meaning the $1 million of liquid net worth, you're golden. You don't need anything. The only thing that people may ask for is validation. So validation or verification. There are a number of verification services which will basically look at your tax documents and your asset values. Like if you have a brokerage account, they'll take a look at that and sort of value your holdings to make sure that you do meet that $1 million liquid net worth. You can ask honestly, the best way to do it is ask your accountant or ask a CPA to do it, or even your lawyer can do it. And then they'll just write you a note for any of these private placement opportunities you want to get into. And that note is good for 3 months to allow you an allocation into that opportunity. If I'm already accredited, I manage my own 506c fund. I don't. So if you're already accredited and you manage your own 506, I don't think that this would really be that helpful for you in this case. I think I'd have to check with how the 506c fund of funds kind of interplays with this, but I don't think that you really get much benefit out of this if that's the case. As a matter of fact, if I'm guessing that if you're accredited and you manage your own fund of funds, 506 was it C deals, yeah, then you basically every one of the investment opportunities you wanted to invest in would already be in your fund, and as a knowledgeable employee of that fund, you wouldn't have to worry about this. You're like doubly accredited. That makes sense.
Okay, and feel free to elaborate too on the question again. If you're asking from an accreditation standpoint, or if you're asking from an advisement standpoint, if it's beneficial to also go through this process if you haven't yet. So advisement. Okay. So that was the question for the advisor side of it. Is there any benefit to going through the testing and setting up under an RIA?
Sticking with this sticking with this example where you already manage the 506c fund, is that right? I'm just assuming that's the case. The only benefits you would get is that you could then also act as an advisor for recommending investment strategies to individuals outside of that fund. I think that's the question. Which candidly may be the key. Maybe that's something you want to do, but you know, personally, were I in those shoes, that wouldn't be something that I'd be interested in doing. But that's fine. If basically the RA allows you to advise outside capital, outside of your fund, to investors, sorry, to clients and other opportunities outside your fund.
Okay. All right. That is it for questions. Ian, do you want to put up your contact information in either the chat and or on the slide before we wrap up?
Yeah, so let's see. Contact information is here. You can either reach out to Brendan or I. Our email addresses are below. I can also just put it in the chat really quickly.
Yep. And then we'll also have these materials sent out in the follow-up with the recording and a copy of the presentation for today.
And then I'll just put this.
All right, there we go. So emails are in the chat. Ian, anything to wrap up?
No, I think that's it. I think, you know, if there are any other questions, feel free to shoot them to those emails or visit our site. And, you know, we'd love to work with some members of your community. Really excited to talk about this today and appreciate the time. All
right. Appreciate your time, Sharon. And thanks everybody for joining. Thanks, Ian, again for your time. We'll talk a little later.
Thanks, guys.
Thanks.